Let's cut through the noise. Because while the headlines are busy celebrating market highs and AI hype cycles, something far more consequential is unraveling beneath the surface. And most people aren't ready for it. I'm talking about a systemic breakdown in the credit markets, a wave of corporate defaults that's accelerating faster than anything we've seen since 2008, and a financial ecosystem that's quietly buckling under the weight of its own leverage. And at the center of this slow-motion detonation, BlackRock. Yes, that BlackRock, the trillion-dollar titan that's supposed to be too big to fail. They just took a 100% loss on a private loan. Gone. Wiped out. And while the mainstream might shrug it off as a rounding error, I'm telling you right now, this is the canary in the coal mine, because this isn't about one loan. This is about a system that's been artificially propped up for over a decade, and now the scaffolding is cracking. So if you're watching this, I'm not here to scare you. I'm here to show you the data, the patterns, and the playbook, so you can protect yourself, your family, and your future. Let's get into it. Start with this. 63 U.S. corporate bankruptcies in a single month, June 2025. That's not just a spike. That's a signal. It puts us on track for the highest annual bankruptcy rate since 2010. And if you remember your history, 2010 wasn't the crash. It was the aftermath. The real wave of bankruptcies didn't hit in 2008. It hit in the years that followed, when the stimulus wore off and the extend and pretend games ran out of road. That's where we are now. The defaults are accelerating, and we haven't even seen the big dominoes fall yet. But they will. Because this isn't a blip. This is structural. Let's talk about BlackRock. They extended a private loan to Renova Home Partners, a home improvement company backed by private equity. Just a month ago, they valued that loan at 100 cents on the dollar today. Zero. Not 80 cents. Not 50. Zero. That's a total collapse in valuation in 30 days. And while $150 million might be pocket change for BlackRock, the implications are massive, because this isn't about the size of the loan. It's about the speed of the collapse. It's about the fact that a supposedly stable asset went from full value to worthless in a month. That's not normal. That's not priced in. And it's not isolated. Renova isn't some outlier. It's part of a broader pattern. Zombie companies, firms that can't even cover their interest payments, let alone their principal, are everywhere. They were propped up by a decade of zero interest rates, cheap debt, and endless liquidity. But now the tide has turned, rates are up, credit is tightening, and the extend and pretend era is over. These companies are running out of lifelines, and when they go down, they don't go quietly. They take jobs, pensions, and portfolios with them. Let's zoom out. Commercial mortgage delinquencies are now worse than they were at the peak of the 2008 crisis. Read that again. Worse. Office and multifamily loans are defaulting at rates we haven't seen in over a decade. In November 2024, delinquencies hit 10.4%. By August 2025, they surged again. Office mortgage-backed securities, 11.7% delinquent. That's higher than the 2008 peak, and multifamily delinquencies, once considered the safest corner of real estate, are spiking too. Why? Because rents have outpaced wages, because vacancies are rising, because the math no longer works. And here's the kicker, the tricks that kept this game going. Forbearance, payment deferrals, maturity extensions, they're losing their power. You can only kick the can so far before you run out of road. And we're there. One example, a $1.04 billion mortgage on a Midtown Manhattan tower missed its balloon payment in August. Instead of defaulting, they got a 3-year extension. But that doesn't solve the problem. It just hides it. And the more they hide, the bigger the eventual reckoning. Now let's talk about who's holding the bag. Multifamily loans make up 45% of the $4.8 trillion commercial real estate debt market. Half of that is backed by Fannie Mae and Freddie Mac. Government-sponsored entities, that means taxpayers. That means you. Banks hold another 29%. Life insurers, 12%, and private mortgage-backed securities, just 3%. So when this blows up, it's not hedge funds that get hurt. It's the system. It's the institutions that underpin your retirement, your savings, your economy. And yet, despite all this, the market keeps climbing. Why? Because of the illusion of liquidity, because of the belief that the Fed will always step in, because people have been conditioned to think that crashes are buying opportunities, not existential threats. But here's the truth. The Fed can't print solvency. They can't make bankrupt companies profitable. They can't force tenants to pay rent they can't afford. And they can't stop the consequences of a decade of reckless borrowing. Let's go back to the root. During the pandemic, interest rates were slashed to zero. It was a lifeline and a trap. Companies borrowed like there was no tomorrow. They refinanced, expanded, bought back stock, and levered up. It felt like free money. But now, in 2025, that money isn't free anymore. It's expensive, and the bills are coming due. Consumer spending is slowing. Revenues are falling, and the debt that once looked like a smart move now looks like a death sentence. This is where private credit and shadow lending come in. As traditional banks pulled back, non-bank lenders stepped in. They offered capital at a price, higher rates, fewer disclosures, less transparency. And now we're seeing the consequences. Companies are defaulting on loans that no one even knew existed. Investors are getting blindsided, and regulators are scrambling to catch up. This is the dark side of financial innovation, and it's happening in real time. So what are the scenarios? Let's break it down. Scenario 1, a soft landing. The Fed pulls off a miracle. Credit conditions ease. Only the weakest companies fail. Sounds nice, but it's unlikely. Layoffs are already rising. Defaults are accelerating. And the data doesn't support a gentle glide path. Scenario 2, a recession-driven wave. The economy contracts, demand falls, and bankruptcies explode, potentially breaking the record set in 2009. This is the most probable path. Scenario 3, sector-specific collapse. Even without a full-blown recession, industries like commercial real estate and retail could implode under their own weight, and that's already happening. So what do? First, get out of the debt trap. If you're carrying high-interest debt, pay it off, now. Because when credit tightens, the banks don't ask questions, they call in loans. And if you're over-leveraged, you're exposed. Second, build your emergency fund. 3 to 6 months of expenses, minimum. I know it's hard. I know margins are tight. But this is non-negotiable. If you have to take on a second job, start a side hustle, cut expenses, do it. Because when the layoffs hit, you need runway. Third, don't rush into investments. Not yet. Not until you've stabilized your foundation. Once you're debt-free and liquid, then you can look at opportunities. And there will be opportunities. When assets crash, when panic sets in, when everyone else is forced to sell, that's when you buy. But only if you're ready. Only if you're positioned. Gold is already breaking out. Over $4,100 an ounce. That's not a coincidence. That's institutional capital moving out of fiat Bitcoin. It's a hedge, a small allocation, 5 to 10%. Not because it's perfect, but because it's outside the system. This is about sovereignty, about control, about not being at the mercy of a system that rewards recklessness and punishes prudence. Because the next bailout won't save you, it'll dilute you. It'll inflate away your savings. It'll shift the burden from the speculators to the taxpayers. Again, and we can't let that happen. We can't keep socializing losses and privatizing gains. We can't keep rewarding failure and punishing discipline. We need a reset, not a rescue. So here's the bottom line. BlackRock's 100% loss isn't an isolated event. It's a signal, a warning, a preview. The defaults are rising, the cracks are widening, and the illusion of stability is fading. But if you're paying attention, if you're prepared, you don't have to be a victim. You can be a buyer when others are forced to sell. You can be liquid when others are locked out. You can be sovereign when others are scrambling for bailouts. This isn't fear-mongering, it's pattern recognition. It's scenario modeling.
Hey guys, in a world pushing you to own nothing and be happy, crypto is your key to survival. Join Angry's Crypto Academy to master buying, selling, and trading crypto. Make huge profits and safeguard your wealth. Plus, discover the one crypto virtually no one is talking about, poised to create new millionaires in the upcoming bull run. The link is in the description of the video below. Go check it out now.
It's strategic positioning, and if you're positioned correctly, you'll be the one holding the map when everyone else is lost in the fog. You'll be the one with liquidity when everyone else is locked out. You'll be the one with options when the system starts closing doors. Because this isn't just about finance. It's about control. It's about autonomy. It's about refusing to be collateral damage in someone else's reckless game. Let's talk about what this means for your next move. If you're a creator, a builder, a strategist, this is your moment. The institutions are bloated, distracted, and exposed. They're optimized for inertia, not agility. And that gives you leverage. If you've been waiting for a reset, this is it. But you have to be ready. You have to be lean, liquid, and lethal. That means no high-interest debt. That means cash flow clarity. That means scenario modeling, not wishful thinking. And if you're running a business, this is where you separate signal from noise. The cheap capital era is over. The margin for error era is over. You need to know your burn rate, your break-even point, your exposure to credit tightening. You need to know which vendors, partners, and clients are sitting on ticking time bombs, because when the defaults cascade, it won't be linear. It'll be exponential. And if you're not modeling that now, you're already behind. This is also a moment for ethical clarity, because the bailout playbook is broken, the social contract is strained, and the public is watching. If you're in a position of influence, whether that's financial, political, or cultural, you need to be transparent. You need to be disciplined. You need to be ready to explain your risk, your exposure, and your plan. Because the next wave won't just be financial, it'll be reputational, and the institutions that survive will be the ones that earned trust, not the ones that demanded it. Let's go deeper. The rise of shadow lending isn't just a financial story, it's a governance story. It's a transparency story. Because when capital flows outside the regulated banking system, it doesn't just escape oversight. It escapes accountability, and that's where systemic risk hides. That's where contagion starts. So if you're an investor, you need to ask harder questions. Who's underwriting the debt? Who's holding the paper? Who's exposed to the defaults that aren't on the books? And if you're in real estate, especially commercial, you need to be brutally honest about your portfolio. The vacancy rates are rising, the refinancing windows are closing, the tenants are struggling, and the math doesn't work anymore. If you're holding legacy assets, you need to model worst-case scenarios. If you're developing new projects, you need to stress test every assumption, because the era of location, location, location has been replaced by liquidity, liquidity, liquidity. Now let's talk about the Fed. Because everyone wants to believe the Fed will save us, that they'll cut rates, inject liquidity, and prop up the markets. But here's the truth. The Fed can't fix solvency. They can't make bankrupt companies profitable. They can't force consumers to spend money they don't have. And they can't reverse the consequences of a decade of reckless borrowing. So if your strategy depends on a Fed bailout, it's not a strategy, it's a prayer. This is why gold is breaking out. This is why Bitcoin is holding its ground, because smart money is moving out of fiat, out of the system into assets that aren't tied to someone else's balance sheet. And while I'm not saying you should go all in on crypto or metals, I am saying you need to diversify. You need to hedge. You need to be positioned for a world where trust in institutions is fading and sovereignty is rising. Let's bring this home. The BlackRock loss isn't about $150 million. It's about velocity. It's about fragility. It's about the fact that a supposedly stable asset went to zero in 30 days. That's not a rounding error, that's a rupture. And it's not isolated, it's part of a pattern. Renova, Zips Car Wash, First Brands Group, subprime auto lenders, commercial real estate, multifamily housing, the dominoes are falling, and the system is creaking. So what do? You model, you prepare, you act, you pay off debt, you build liquidity, you diversify, you protect your downside. And then, when the panic hits, when the assets crash, when the system seizes, you buy, you move, you build. Because that's how wealth is created, not in the boom, in the bust, not in the euphoria, in the reckoning. And if you're watching this, you're already ahead. You're already thinking. You're already modeling. So don't stop. Don't wait. Don't hope, act, because the next chapter is being written right now, and you get to decide whether you're a spectator or a strategist. This is the moment. This is the signal. This is the shift. And if you're ready, if you're positioned, if you're disciplined, you won't just survive, you'll thrive. You'll build. You'll lead. Because while the institutions are collapsing, the opportunities are expanding, and the future belongs to those who see the cracks and build through them.